Okay, last video in the Chapter 7 lecture series. Yay! Alright, so we are going to be talking about some additional procedures you might be using when you're auditing revenues and accounts receivable. So we talked about confirmations on the last video. That's an important substantive test of receivables. So that you're testing your balance, right? Now, we also want to make sure things are in the proper period, right? So we need to do some substantive tests for that. That's really not something you can, well, you can do it analytically because you can say, okay, well, end of month should have this balance. Does it match with last month or something like that? But you're going to definitely try to verify that things are in the proper period, right? In other words, they didn't go ahead and in the December 31 financial statements, they didn't include like the first week of January, right, to get a little extra sales in there. They didn't do anything like bill and hold. They didn't do anything like channel stuffing to try and get extra sales in there before the end of the year, right? Because remember, to be a sale, it has to occur in the period, and in that period means they had to have delivered the product or service, and it also means they have to be likely to collect for it, right? So if it's going to get returned, that's not a sale. All right, so your sales cutoff procedures are where you're verifying that it's in the correct period. All right, so clients will do things like hold the books open, right? Like, oh, I know this big order is coming in, so I'm not going to close until the 3rd of the month, something like that. So and that they can hold books open and it can make some sense sometimes, but they still have to record it in the proper period. Examine invoices and shipping documents. So what you want to do is get those cutoff period documents. So the last few days of the month and the first few days of the month, right? And see when things were shipped. Look at the invoices. When was that sale related to when it was shipped, and compare it to what's on the books. Also, returns. So an important factor is that it's likely to be collected. So you could have an instance where, yes, a product was delivered, but if it was returned, the client's not going to pay for the client's customer is not going to pay for it. So it's not realizable. So you need to check for returns. So if the cutoff date's December 31, you need to look out into January, maybe even the beginning of February, and see if things got returned. Or what is their return policy? Maybe there's no returns. Then you don't have to do that. But check on the return policy, and if it's very lengthy, you may have to go way out and check. Okay. So sometimes when you do your analytical procedures and your substantive tests of details, just your normal procedures like vouching, tracing, and confirming, those are pretty much the typical tests of details that you do for sales, vouching and tracing, and for accounts receivable, vouching, tracing, and confirmation. Well, sometimes you do some other stuff, right? Maybe confirmations don't work very well at your clients. They just don't. People don't respond to them. They have some strange customer base and they just don't respond. So what could you do? Well, if your client's customer actually paid that invoice, then okay, that was probably a legitimate invoice, right? So you can find what invoices were due on December 31, and then go look out in January and February and see what invoices got paid. And if they got paid, you can kind of assume, yeah, that was probably a legit invoice on December 31st. You can look at shipping documents, BOL, that stands for bill of lading. That's that piece of paper that UPS or FedEx gives you when you give them something to ship. So that's going to have shipping dates. And if it's a third party doing the shipping, right, not your client. So some clients have their own shipping, right? But some clients use UPS and things like that. So that's good evidence. You can use client-generated documents, but they're not as good as third-party stuff, right? So that's why we like those confirmations. That's why we like those bills of lading, right? But if your client has good internal controls, if they couldn't be faked, then you could rely on your client's shipping documentation, right? You're auditing Amazon. Some stuff they ship themselves in their own vehicles. Some stuff UPS ships, right? So you can look at their controls. You can look through correspondence. So if there's something wrong, your client may have complaints and things from customers. So that's a good spot to look. Those customer complaints can tell you stuff. If there's a lot of bad debt, look at that. See if the evaluation is reasonable. If some account is not collectible, it needs to be written off. So you should be looking for things like bankruptcy notices, letters from clients saying we're not going to pay, and make sure that your client has written those people off, right? Because once it's known they won't pay, they need to take that off their books. It's no longer an asset, it's an expense, right? So look for that. Make sure they have a process in place. Oh, after 30 days, we try to contact them. After 60 days, we send a notice. After 90 days, we write them off. And just that there's some procedure in place for writing things off. And it's important that there be specific authorization to write off. Because remember, if somebody's faking accounts receivable for some reason, I'm stealing the payments that customers are sending in, so I need to get the receivable off the books, or customers will complain. So I write them off if I'm the thief, right? Well, there needs to be authorization for write-offs. Not just anybody can write them off. And certainly not a person with access to the checks and cash customers pay. That's very, very bad control. So inspect and make sure that, the credit manager inspects the accounts receivable and signs an authorization, and they don't take it off the books, the accountants take it off the books, right? There's that segregation of duties. So there's authorization and accounting, they're separate, but there is an authorization process, and it's appropriate. As an auditor, you don't want to see things hanging around out there for 120 days. That's not going to be collected. There needs to be immediate authorization for write-off upon notification of bankruptcy or customer denial of payment. There needs to be a reasonable write-off within, say, 60, 90 days. So look for that stuff. All right, so the rest of these slides are not something we're going to do much with, but you can know that, of course, the analytics gets used by auditors. That's your analytical processes. PCAOB has a lot to say about the reviews. All right, so that's it. The next thing will be your test. All right, so go do the exam review stuff.